Okay, thanks for joining us for this month's housing market update. The U.S. struck Iran on February 28th. There's been a war going on ever since. 20% of the world's global oil supply is at jeopardy as Iran has shut down the Strait of Hormuz, or at least, tightened it so that oil can't really flow. Here's some other quick stats that are impactful. Brent crude surged from $70 to over $110 a barrel. U.S. gas prices jumped 35 cents a gallon in 1 week. The 30-year fixed mortgage rate climbed back above 6.1 on inflation fears. There's a lot going on out there, so let's break it all down and check out how this impacts the U.S. housing market. What does this mean for you, the U.S. housing market, and your home? Well, like I said before, Brent crude jumped big time. Large percentage gain, over 110 barrels since the first time in quite a long time. Gas is up, mortgage rates are up. The bottom line is higher oil prices are stoking inflation fears, right? And that's ultimately pushing bond yields, which means that mortgage rates are higher, which means that it may put a bit of a damper on the housing market in terms of what buyers can afford. Affordability, as we've been talking about the last few months, is the central problem. So here's some historical perspective. I think it's always important to have historical perspective. We've been down this path before. I think that's the point here. So in 1973, OPEC had the oil embargo. I don't mean to brag, but I was not old enough at that point in time to deal with the oil embargo. Many people watching this were, and you remember the lines. I've seen the video footage from years ago. Oil quadrupled to $11 a barrel. Imagine that. So divide 11 by 4, and that's what oil was. Now it's over $100 a barrel. So that gives you an idea of how much inflation is set in. Then we had the situation. And so the point is, in 1973, everything happened, but we lived through it, right? We got through it. 1979, the Iran Revolution happened. Iran cut oil exports entirely, completely cut it. Prices doubled to $39 a barrel. We got through it. It was certainly a tough time, but for those of you who were in the housing market back in the early 80s, you probably remember 15 to 20% interest rates, right? The oil had something to do with that. We had an oil surge back in 2008 as well. Oil doubled in 1 year, compounding the mortgage crisis that was underway, part of the financial housing market collapse. And then we have this situation here in 2026 where oil surges, inflation fears spike, and mortgage rates have jumped. So this is not something we're unfamiliar with. We've been through it before. So there's two scenarios here, right? This conflict ends in a short order, or it becomes a prolonged conflict. I think everybody in their right mind wants this thing to end quickly. Certainly a lot of economists do, because they see the danger in it, right? So if it is a short conflict, things should settle back down. The spring home buying season can kind of kick back in. Buyers who are on the fence, jump back in. Home prices remain solid, and we just kind of keep going, right? That's one scenario. In a prolonged conflict, well, it's going to, potentially push inflation up, right? Because oil's more expensive. Everything becomes more expensive. When oil's more expensive, that means that the Fed is not going to be motivated to do a rate cut, which could help mortgage rates. So that means that the Fed is going to keep rates high, or maybe consider adding to the rate. Not likely to happen, but maybe they just don't cut, which we're hoping they do cut, so that mortgage rates can continue to come down. The spring market stalls, and then there's a potential for stagflation, which is real calamity, far worse than inflation, where there's rising prices, i.e. inflation, but a slowing economy. That's true peril for an economy. So we hope that there's not a prolonged conflict. That's the bottom line. So what are the numbers telling us right now? Well, existing home sales are down year over year in January by 8.4%. It's the largest monthly drop in 4 years. Okay. Now, there was a fairly large amount of home sales the month before, so that's why you have such a variance there. But needless to say, it's a pretty large drop in the number of units sold, which If you've been following the housing market update for any sort of time, I've been saying for years, the key metric of all metrics in the housing market is how much is moving, how many units are being sold, right? Because it triggers everything. Remember, the housing market accounts for almost 17% of GDP. Why? Well, because every time a home sells, furniture is bought, painters are hired, plumbers need to fix things, contractors need to go in. It just spurs economic activity. So it's a real damper on the whole economy if things aren't moving. Okay. The median home price did continue to increase, but at a much slower rate, less than 1 point. But it is the 31st straight month of annual price increases throughout the United States. It's a pretty remarkable run it's been on. Inventory supply, it went up 3.4% from a year ago. So that's a year-over-year number. That means inventory is building. If you look at city by city projections, what's going on in the marketplaces, it's almost about 50-50. Half the metropolitan markets are on the decline. Prices are coming down. Half the markets are continuing to go up. You put it all together, and it's just a little bit of an increase. And the 30-year mortgage rate slipped above 6% right after the Iran conflict happened. So those are some of the macro factors that are happening in the marketplace right now. Locally here in Orange, Sussex, and Passaic counties, January and February, this shows us new listing activity. And you can see that, 25 last year is noted in blue. Green is this year, 2026. And you can see in each county, it's down, right? The number of new listings. So that's not necessarily what we want to see, right? Buyers need inventory to buy, but we're still not really seeing a major increase in inventory, not yet. Here's on an annual basis to look at the number of listings. I think it's interesting to note that in Orange County alone, Orange County, New York alone, back in 2019, there were 6,000 new listings that made it to market. In 2025, that was down to 4,000. So near historic lows. The data what it means for buyers and sellers in our local marketplace. Well, inventory is still tight, no question about it. Sellers still have leverage, although there is, evidence, a lot of evidence that if the price is not in a good range, the house is not going to sell. And I think a lot of us who are, boots on the ground dealing with buyers and sellers will know that that is the case. That homes they have to be priced within a reasonable percentage of market value. Otherwise, they're not going to move. But they are still, on average, selling above asking. 101% is the average. So buyers, don't wait for the perfect rates. Because of this Iran conflict, what's going on with oil, a lot of experts on the matter are now predicting that maybe rates are going to stay above the 6% range for the balance of the year. We're going to take a closer look at that in just a minute. So let's go right now to it. Let's bring Amy Green in, my big sis from Quintessential Mortgage Group. Amy, welcome. Let us know when your mic is opened up.
Yep.
All right. So rates just hit, a 2-year low, and then they bounce back. So are you and your sources agreeing that we may be north of 6 all year long? Is that what everybody's starting to say, or what are your thoughts on that?
I do think that is the consensus. I will say they did dip, just like you posted there. Just before this Iran conflict, they dipped right below 5%, which was so exciting. That's what we've been talking
Right
about.
below 6%. 6%.
Right below 6%, right? Sorry. And
Yeah.
But that was due to the labor market, right? So there were 92,000 jobs lost in February. Unemployment ticked up a little, which puts downward pressure on the rates. And that lasted for literally a couple days. And then the Iran affair happened, and then the oil, and then everybody panicked. Oil went up, rates went up, which by the way, they're at the same exact level today as they were 1 month ago at our last meeting. So overall, the past month, they've held steady.
And to the next point, this, I thought this was interesting, is that, the buying, if you're a buyer, your buying power is actually better than it was last year. Because of rates. Rates are basically significantly lower than they were this time last year. And wage growth on the aggregate is outpacing price increases. So that's something positive to think about.
Definitely, because last year at this time, rates were in high 6s and 7s. So we're still ahead of the game.
And on top of that, excuse me, the rate at which home prices are increasing is slowing. The rate at which they're still increasing, but the rate at which they're increasing is slowing. So that's a good thing for buyers as well. So do you agree with this, Amy? 3 great things that get you the best rate right now: credit score 740 or above. True or not true? Is that kind of a magical mark for credit scores?
Yes, and even higher. The higher, the better. But yeah, 740 is a good mark. I would say 680 is like
the min.
A real good mark. Like if you're under 680 and conventional, you're gonna pay for it. 740 even better.
Right. Okay. Debt to income ratio under 43%.
Yes, especially with conventional and jumbo loans. That is a factor. Yes.
Okay, cool. And then, like we said before, don't wait, right? I think lock in your rate now if you're waiting. I don't know that I would wait. I think I'd lock. But that's up to you.
Yeah. I mean, in most cases, yes. However, it is up to the buyer, right? So it's their choice, which is good. And the other thing I would say, one more thing to get you the best rate is loan to value ratios, right? So 85% loan to value is going to be better than a 95% loan to value.
All right, cool. Amy, we're going to pivot to something, to some other final information to close us out. Do you have anything else that you want to share before we do so?
I would just say it's still a great time to buy. Interest rates are low 6s. So keep on keeping on.
There you go. All right. Thanks for checking in, Amy. Appreciate it.
Okay,
so let's wrap this up with the key takeaways. The Iran war, it's a wild card. There's no question about that. It's already pushing rates up. Hopefully we're in for a short conflict, not a long one. It's not the first time we've had oil shocks before, so we don't need to panic. We've been through this. We'll get through it. Let's not panic. Okay. National home sales fell 8.4% in January. Home sales, not price, home sales, right? Don't mix those two up. It's the biggest drop in 4 years. So that means buyers pulled back, but prices still rose almost a point. Local inventory is still tight here in Orange, Sussex, and Passaic. Great time to list your house, quite frankly, right? It's spring. The snow is melting outside. If you've been thinking about listing, you're holding off, great time to list because there's still a relatively low amount of competition. So you'd be crazy to not actually list soon if you're thinking about it. And then, mortgage rates are still near 6%, right? Far better than they were in 2023. I think that's the important point to think here, is that, you can't wait for the perfect rate. Affordability is, all things considered, wage growth, inflation pressures, mortgage rates, home pricing. It's actually a little bit better of a scenario than it was 12 months ago. So if you're thinking about buying a home, you're holding off for whatever reason, press on. Owning a home is one of the great wealth building strategies known to mankind throughout our history. So thanks for joining us here at the Housing Market Update. Hope to see you next month.